This video, we're going to look into how you can hedge a long stock position with options. And this is going to give you a pretty good understanding of the strategies, whether you're a beginner or you're a seasoned stock trader, it doesn't matter. So when you hedge a stock, it's a strategy that you use to protect your stock, your investments, from the downturns in the market. And when you own stocks, using options to hedge can minimize potential losses when the price drops. So let's look at a covered call strategy. Now, this approach is about selling a call option on stock you already own. So it's a way that you can earn income through the premiums that are paid by the buyer of the call option. But it does not offer a whole lot of protection if that stock price significantly drops. So I want you to imagine that you own shares of XYZ company. And let's say it's currently trading at $100. You could sell a call option with a strike price of $110 that expires in a month. So this means that you're giving someone the right to buy your shares at $110 within the next month. And for this right, they pay you a premium. Let's just say it's $3 per share. Now remember, you need 100 shares of stock for each options contract. So here you're going to earn $3 a share. That's $300. So if the stock stays below $110, that option will probably expire worthless. You're going to keep both the shares and you're going to keep the premium as income. Now this strategy, it's really beneficial when you're moderately bullish or even a stable market, but there are risks if that market decides to surge. Now let's talk about the protective put strategy. So this is where you buy a put option for the stock that you own. So this is like an insurance policy. You pay the premium for the right to sell your stock at a predetermined price, and that's going to offer you some protection against a significant drop in the value of your stock. So let's say you own shares of ABC company and it's trading at $150, but you're concerned about the potential downturns. So you buy a put option with a strike price of $140. It expires in 3 months. And that premium is $5 per share. So that costs you $500. So you pay $5 for the share. So if the stock falls below $140 before expiration, you can sell that at $140, regardless of how low the market price has dropped. So this is going to limit your loss to a maximum of $10 per share. That excludes, though, that premium that you paid. This is a good strategy to use when you're uncertain about the market or if you're anticipating a temporary downturn in generally what is a bullish stock. So when we compare the two, the covered call is going to generate you some income, but it does lack the downside protection. On the flip side of that, the protective put gives you a guaranteed sale price at the cost of the put option premium. Caller strategy, this is going to combine these approaches. So it involves selling a call option, buying a put option while you're holding the stock. This is going to balance the cost and provide both income and downside protection. So you're holding a long position in a stock, you sell the call option, you buy the put option. The income from selling the call option helps offset the cost of buying the put option, so the put option is cheaper. This strategy creates a range where your stock is protected against significant declines while still allowing for some upside potential. So let's say you own XYZ company shares, it's $100. You might sell a call option with a strike price of $110 and buy a put option with a strike price of $90. The call option sale gives you income, reduces the cost of the put option, which will protect you if the stock falls below $90. If XYZ stays between $90 and $110, you benefit from the call premium and you're protected on the downside. And this is pretty useful in uncertain markets. You want to limit your potential losses, but you want to maintain some potential for your profits. A balanced approach. So some key factors here. You got to think about the strike price selection. You got to understand the risks of options assignment. You got to manage downside risk and consider the market conditions like volatility and time decay. Now, we have our own methods of handling all this at NetPicks. And you can reach out to our support staff, support@netpicks.com, and they can help point you in the right direction if options is the route you want to go. So wrapping this up, hedging with options, it's a strategic approach to safeguard your stock. Each strategy, whether it's covered calls, protected puts, or the collar, there's unique aspects to consider for effectively using these. Again, feel free to reach out to our support staff. Remember, subscribe. We'll talk to you later.